Hello, everybody. Thank you for joining another episode of Arthur's Roundtable. Thanks, everybody, for being with us today. I have with me a longtime friend, colleague, Kim Lochridge, Engineer Tax Services. And I don't know, we've known each other maybe 10 years, something like that. So, super happy to have you with us today. You want to give us just a little context, background, how you got started in all this, and then we can take it from there.
Sure. Thanks, Art. It's always good to see you and a pleasure to be on the roundtable. I am Kim Lochridge. I am the Executive Vice President of Engineered Tax Services. I've been with the firm for going on 17 years. And, I've been a real estate investor since the late 90s personally and have, a nice portfolio. And I'm also on the tax committee and the sustainability committee for the Real Estate Roundtable in Washington, D.C. So I'm involved in, lawmaking efforts and collaboration on a lot of those, bills, the most recent, the OBBBA bill, of course, but collaborated on many others in the past. So thank you for having me on the show. It's really good to see you. It's been a while.
Yeah, it has. So, being that you have some input on policymaking, and also you're the most exciting accountant I've ever met, so to speak, the we've talked in the past about there's hidden gems in the tax code aside from the engineering that you do for deductions and all that, although that's significant. Is there anything in this bill that you'd like to chat about that the audience would appreciate hearing?
Well, specific to real estate, obviously the buzz is the 100% bonus depreciation coming back. That was huge in this most recent bill. It was in the attempted American Families and Workers Act, which was last year, that did not pass the Senate for multiple reasons, but mostly because it was bundled with some child tax credit and some other credits that we're not going to allow it to fly. The bonus depreciation has been something that we've been knowing that would come back. It's been a bipartisan requirement or request that it does come back. It was just a matter of the vehicle that it's put into. So now the OBBBA bill ended up passing, so we did get the 100% bonus depreciation back. I think one of the key things on the changes is making sure that everybody knows and understands that it did change the definition a little bit, which could be significant, right? So the definition clarifying previous to the OBBBA bill, we had in the Tax Cuts and Jobs Act the ability to apply the bonus depreciation to properties that were placed in service at a certain time period. The change in the OBBBA bill is that now it does require an acquisition date as well as a placed in service date. So prior it used to just be placed in service. So that was a pretty big change. Some people who purchased properties in 2024 and didn't place them in service until 2025 might think that they could qualify for the 100% bonus depreciation, but in all actuality, since it was acquired in 2024, it's going to revert back to the Tax Cuts and Jobs Act, and they would only be eligible instead of 100% bonus to the 40% bonus, which was the Tax Cuts and Jobs Act, rules. So I think that's one of the biggest changes is the acquisition. Yeah, it's acquired and placed in service. You have to meet both of those requirements. And if you don't meet that, then, like I said, it just reverts back to the Tax Cuts and Jobs Act rules.
Is there a workaround, depending on the state, where you can execute a trade without the expense associated with whatever state tax? In other words, is there a form over substance, you can get away with it type execution? So if you owned it in 24, can you sell it to yourself again in the 25th or a different entity to solve that problem?
Unfortunately not, only because we have, common ownership and arm's length transaction rules, right?
Yeah.
So if you're selling it to yourself, bonus depreciation does not start over. Depreciation in itself does not start over. Essentially, you're just transferring it from one entity to another. It's still the same, and it is still required to be, depreciated. So the only way you can get out of it is really just selling it outright, buying another property, or doing some sort of 1031 exchange or something like that.
Yeah. We talked about at one time, I can't remember exactly when it was, that there was a key component of some of the tax law, and I'm being amorphous, not on purposes because I don't know what I'm talking about, having to do with car washes, for example. Is there any golden nuggets like that that are available now for people to invest in?
Yeah, there've been special rules for car washes and gas stations since 2011, actually. But I don't think people really paid attention to the rules, simply because it wasn't until 2017 when the bonus depreciation came in that completely changed everything. So essentially, the car washes and gas stations, and let me clarify, car washes and qualifying gas stations. Okay, it's not every gas station. There are certain rules that would apply and not apply. But if you have a car wash or a qualifying gas station, those assets, net of land, the depreciable basis goes into a 15-year classification instead of 39 years like normal. Now, where this really becomes interesting is that when you put the asset in a 15-year bucket, the entire bucket becomes eligible for bonus depreciation. So with the 100% bonus that came out in 2017, you can buy a car wash or a qualifying gas station and essentially, write off the entire basis, right, net of land basis. Obviously, you have to pull out land, it's not depreciable. But that makes for very strategic tax planning. Personally, I own several gas stations. I'm actually under contract to buy another one for this year. Gas stations, car washes, I'm in a car wash fund, I'm in a gas station fund, a bunch of different things like that. And it does make a huge difference. If you're, kind of running the numbers on for every $1 million, if it's $1 million in net basis, essentially you're going to come up with about 30 to 35% equity. So you got 350,000 that you put in, but when you pull out, 20% for land, so you have an $800,000 basis. Essentially, you're getting a deduction for $800,000 in the first year. So it becomes extremely strategic as to when you put something like that in your tax return, and obviously talk to your CPA.
Right.
Make sure that you, don't have the limitations. There are some limitations, but it just depends on how you're filing. So. I was going to save this question for after the recording, but I'm going to ask it now. Is there anything that you know of that applies to CapEx specifically related to ISPs, like internet service providers? And the reason I'm asking is there's a bunch of people that are trying to put their ISP in developments with the developer to have a recurring revenue stream, rather than they're using the same cables and wires or whatever that Comcast does. It's just that there's the ability to have your own sort of intranet web ISP for a community and cash flow it rather than paying Comcast, for example. Well, anytime we talk about CapEx, we're talking about capitalized expenditures, right? It's capitalized expenditures. It indicates to me that if you've done a cost segregation study on your property, you have all of the value to what was there at the time of purchase, right? So you're establishing the value of everything. And then at that point in time, once you start ripping something out and replacing it with the capital expenditures, so new lines or wiring or cabling or whatnot, then you have the ability to take the partial asset disposition, which should be the case. So what you're going to do is you're going to, expense the remaining depreciation of the assets that are removed from that property and take a deduction for that as you capitalize the new expense. So just think of it, it could be cabling, it could be anything. Anytime you have a property that is depreciable, an income producing property, you're doing capital improvements. And if you're capitalizing the new assets, then you can then remove the assets that were removed at the time that they're taken out of the building. So you should be writing them off on the books. You can't do that unless you've done a cost segregation study. So that's one of the things that we've talked about. Engineered tax services, they do cost segregation studies. That's what we're known for. And so we can establish that baseline and prove to the IRS what was there at the time of purchase, and then come in and remove those assets as the capital expenditures happen.
Super interesting. All right, well, I'll stop asking for free advice now. How about let's talk about your ideal client for a cost seg, for example. Who's a good candidate? 'Cause I'm sure a lot of people that will be listening to this they're aware of cost seg and may or may not have done it. Can you profile what the type of customer that's good for you and good for them, for example?
Yeah, so the type of person that would be a good candidate for cost seg is like literally anyone who owns and runs, investment property. The sky's the limit. It really doesn't limit. I think, a lot of times people will come to me and they'll ask me, hey, what is the best type of property for cost segregation? What is this? What is that? But really the real question I think people should be asking is, how is it going to flow through your return, right? Because anybody can do a cost segregation on any income producing property, period. So if you have income producing property, you should be doing a cost seg study, regardless of whether it's ordinary offset or passive offset. And the reason is like a lot of times, CPAs are saying to their clients are like, you shouldn't do that because, you're passive or this is passive activity and you have passive losses already. But there are so many reasons other than just the passive offset to do a cost segregation study. And so I think even CPAs end up getting limited to seeing the value of a cost segregation study, even in the event of a passive investor. It should be used and utilized as a tax asset. So if this does increase the passive losses that you have, so then that taxpayer needs to get strategic and figure out what they can do to drive more passive income to offset those losses. There are so many things that you can do instead of just saying, oh, that's passive and you can't use it right now. Okay, but
Yes.
can I use it next year?
Right.
How am I going to utilize this in my taxes? Or how could I utilize, right? You don't want to just write it off and say, oh, whatever, let's not do it because it's passive. I think that's lazy, to be honest with you. Because, even looking at it that way, let's say you do have passive, this is a passive investment for you. You do a cost seg study and you generate a bunch of losses. You can sell that property and all of those losses now offset your gain, any recapture, and those losses that were banked now convert to ordinary when you sell it. So you might not realize the benefits like you would if you were an ordinary investor or if this is an offset to your ordinary income, but you still realize the benefits eventually when you sell it. Or, essentially, people say, oh, don't do cost seg because of recapture. Like, think about that. Think about that all the way through. Okay, so I don't do it, but I might have to pay recapture. But what if you did a 1031 exchange out of it? Or what if we did a lazy 1031 exchange? Or what if we did all of these other things that we could do to offset, those losses? To me, I look at this as a huge gift from the IRS. I look at it as a tax deferral, and what can you do with the power of that money in your pocket right now, regardless of whether it's passive or active. So, as far as candidates go, anyone who has income producing property should be doing a cost segregation study, in my opinion.
Yeah, that makes sense. It also makes sense to have a bucket of reserve because you don't know what the future is going to bring, right?
Yeah, I
In
mean,
your
why not?
in your
I
your
mean,
examples, and the cost for doing it is de minimis. I mean, I'm
it's minimal.
not trying to be your salesman, but it's not that big of a deal. And if you paper it up, it's papered, right?
Yeah. And the fees are tax deductible. So, I mean, come on, really start looking at the facts. And it just kills me sometimes where I just get, certain CPAs. I love CPAs, don't get me wrong, but certain CPAs are just so stuck in their ways, like, oh, this isn't going to benefit you, and just totally write it off. And you have to understand as a CPA, you have leverage, you have power over the decision making that your clients do. Please make sure that you're giving them the most correct information. Like, let's run it through a pro forma, let the client make the decision, right? Then what happens, because typically a lot of CPAs are not investors. They're not thinking like investors think. And so you have to be well aligned with that mentality. And, before you just blindly take the advice of somebody that, is like, oh, don't use that, you can't use that. It's such a disservice.
Yeah, scenario planning, right? That's all.
Yeah. Yeah. And I mean, people have savings accounts, right? They have income and then they have savings accounts for a reason. So why not do the same thing with your finances, right? Have a savings account in your finances. Have those buckets of money that have those losses that you can bleed over income into certain places. Like, oh, well, this is going to be on my passive side of my return, or this is going to be on my investment side of my return, or this is going to be on my active or ordinary side of my return. Great. What can I do to leverage those buckets, and where can I move different activities around to make sure I'm utilizing those losses? Don't just let them sit there.
Yeah. I don't mind disparaging accountants, and so I won't make it harsh. But
I have some really, really good ones, though. There are some really good accountants out
I'm,
there. So,
but it's been my experience, depending on the accountant, is that they do the tax returns instead of saying, "Well, wait a minute, what's going to happen next year? Let's move the chess pieces around a little bit," because it's not easy, and it requires more work. But it also requires a point of view. Like you said, a lot of them aren't investors, so they didn't think about it as an investor does. Because if I need to generate ordinary income, or I anticipate having ordinary income, then I need to do something this year to offset that next year. I mean, it's not rocket science, but they're usually just doing returns. And again, I don't mean to be harsh, but the and you don't have to get close to any lines to do any planning, right? You can stay totally bright line and work within the dots.
well, let's unpack that for a minute, right? So, CPAs traditionally, they record what has happened in the past. That's their job.
Right.
They are recording and substantiating what has happened in the past, what happened last year, and let's substantiate it this year. So their mindset is always looking retroactive. They're trained to look retroactive.
Yeah.
They really aren't in the position, it's not their job to look proactively and do pro formas. Yes, certainly they can run the calculations, but they're so busy trying to do the tax returns from the past. That's not the mindset typically. Now, where I do see strategic tax planners coming into play would be maybe a tax attorney. A tax attorney is the one who's going to be setting you up for success and building that pro forma and working hand in hand with your CPA. I do have a CPA that does a ton of proactive tax planning with me. We have quarterly sessions where I'm actively sitting down with them. Here's what is going on thus far. This is what I'm thinking. Where do you think I'm going to be this year? Plus and minus it out. And that is the most important thing that you can do for yourself, is to make sure that those things are in place, and that you're being proactive about making sure that you're setting up the meetings with either your CPA or the accountant and asking those questions. Don't wait for your CPA to come to you, because they won't.
They won't. Yeah.
I'm sorry, I don't care who you are.
Yeah.
But that is something that I think is important. And the one other point that I wanted to make is, and I know you've heard this before, but the statistics, CPAs right now, is that 70% of all practicing CPAs will be retired in 5 years.
So everybody's aging out?
Everybody's aging out. We don't have enough young people coming into the industry. The problem is they don't have capacity, right, for what you want them to do or what you're needing. So take that into your own hands, right? Educate yourself about what you need to do. Keep a spreadsheet. Here's my pluses and my minuses. It's not that hard. Here's my losses. Here's my depreciation. You start to keep track of that and really pull that activity in your own hands, right? Arthur, I think I lost you there for a minute.
So when somebody's coming to you, are they usually coming to you on the arm of the accountant, or it's because they've been referred in? How's that generally happen? Or is it the tax attorney?
Yeah, so I've been doing this for a really long time. I have relationships built up, for decades. And I would say 100% of my work comes from a referral. It's either a referral from somebody I've already done a cost seg study for, a CPA that I work with. There are some really good CPAs out there. The people who get it, right? Especially ones that specialize in real estate. And also tax attorneys I work with. I work with, commercial brokers, so, my business comes from many, many different directions, but 100% of my business, I haven't made an outbound phone call, for work in probably a decade. But, we're probably running somewhere between 600 and 800 studies a month across the country. And it's a ton of real estate, which is also one of the benefits that I have on the Real Estate Roundtable, is that we see trends that typically a lot of people don't see. We get to see trends in the real estate market that, that a lot of people just don't have visibility to. Rather, maybe they're focused on a specific sector, or maybe they're focused on a specific region, but very few people have that visual of being able to see, trends coming through with certain property types in certain regions and that kind of stuff, which I think is very unique perspective.
That's super interesting. You should get paid for that. The but do you see from time to time, or let me ask it differently, how often do you see brokers who are trying to sell a property, trying to get to a price, and ask a study to be done so the buyer can see that the economics are going to benefit them? It's just another data point on arriving at a decent price, right?
I do see that more and more this last year. I have more brokers and more, a lot of clients, larger clients, family office clients that I've been working with for years and years, and we've done cost seg together, who are looking to sell their business, and they want quotes for what that would look like for the buyer. I think the problem that we face in that regard is that, you start talking about it from that perspective, and then as soon as the client goes to their CPA, the CPA will poo-poo it for whatever reason and say, some CPAs, right? Well, you're not a real estate professional, so you can't use it, or you have a $540,000 limitation, and I'm like, there are so many ways around that. You have the 199A rules. We have those other things where you can take in excess. I mean, I buy, car washes or gas stations or real estate every year, and I'm writing off millions of income every year. So, that there are ways to do it. You just have to find a sophisticated real estate focused CPA. But I am seeing an uptick more and more of people who are looking to utilize this as a sales opportunity, especially in the car wash and gas station space, and then also a lot with my commercial brokers that I work with that are looking to push those. In fact, we put a lot of the cost seg decks or a page about cost segregation in a lot of the OMs, or the brokers that I work with.
Are you feeling good about the wash business right now?
So that's a good question. You know, we were talking about trends, right? So the car wash business, that's definitely trending. You know, we're at the peak, right? um, I think there's a little bit more opportunity with gas stations only because they're a little bit riskier because people worry about, you know, leakage and environmental concerns and, you know, electric vehicles and that kind of stuff. But I'm still bullish on gas stations because I think they're still easy to find a pretty decent one that has a good cap rate. Car washes, they're a little bit inflated. I think they're a little more expensive, and I think that people see they're not as restricted as gas stations, and so it makes it a little bit easier. And this is why you see car washes popping up on every corner. It doesn't matter where you go in the country, there's a car wash popping up on every corner. Whether it's a Mr. Car Wash or, you know, Lynx or something like that. I mean, you're seeing them across the country, and that's because of the incentives, you know, surrounding that. At some point in time, yes, it's going to get inflated, and we're already seeing car washes, you know, increase in value simply because people are starting to find out about the 100% bonus depreciation, especially with it coming back in the OBBBA bill. So
Little frothy already. And the gas stations, are the tenants, AAA tenants like Exxon, Mobil, et cetera?
Not typically, not typically. They're usually the operator. So, but you can find gas stations. You know, you can find gas stations where you have the corporate guarantee, and then you also have an operational personal guarantee, which is what I prefer. You know, is a little bit more secure, and then you also have. You know, when you have those guarantees, you actually usually get better lending options. So, you know, I do all my own underwriting on those. And like I said, we're in contract of doing another one this year. It's, you know, yeah, I mean, you do a little bit more due diligence with the gas stations, but they are out there. Typically, you like I said, the lease is with the operator, but you have, you know, a guarantee with the corporate, whether that's, you know, Exxon or, you know, a bigger organization, and it's usually a triple net lease.
And is the operator not inclined to own the real estate?
Well, you know, it's like certain types, right? So there are certain types that tend to lean towards the model of you know, a renter. The businesses really want the capital. So they don't want their capital tied up in equity in the business, in the building. They want to be able to reinvest that capital in the business. And so the business model, like Fresenius, DaVita's, CVS, Walgreens, Family Dollars, Dollar Trees, you know, those are your typical triple net lease, you know, type, you know, situations where you get into, you know, where the operator or the corporation just does not want the real estate, right? They just want to pay the rent based on the proceeds and call it good. So they don't want to carry the, you know, the
Balance
liability
sheet.
and
Yeah.
the
Yeah.
balance sheet. So typically with triple net lease, it's just a model. It's just a business model.
Yeah.
And essentially that's the way it is with gas stations as well, you know, so they don't want to carry that on the books.
Is there a region, you're probably focusing on where you live, but is there a region where gas stations are more interesting than others, or is it all over the place?
I think it's all over the place, and I don't usually invest where I live. I live in Arizona. I'm in Scottsdale, but you know, I've got property in Texas and South Carolina. I've got property in Oregon, Colorado, you know, Arizona, Texas, I think I already said
Yeah.
Texas. Yeah, so I've got properties all over the place, especially triple net lease. It makes it a lot easier for me,
Yeah.
Massachusetts and all kinds of stuff. So,
Yeah.
yeah, I don't think it really matters. I think the key points for me when I'm looking at those, just I look at the operator, I look at the financials. I want to find one that performs higher than the rest. So if they end up going through cuts or something, that they're not going to cut mine out, right? So I look at the revenues. I look at the environmental. I look at location. Where mine right next to a university, so there's a lot of traffic. So there's a lot of things I look for in the underwriting.
Yeah, I don't really want to get into the weeds, but can is it fair to ask, 30%, or if it's triple net, it doesn't really matter, coming from the junk food in the gas station, and 70% coming from the gas? Is there any sort of typical metric?
Yeah, there is a rule for that is one of the three rules that you have to meet in order to qualify for the 100% bonus depreciation on a gas station. It's one of three things. The first one is that the square footage of the store itself needs to be less than 1,400 square feet. The second one, which is hard to do because that's smaller and smaller, right? So the olden days, it was a little bit easier to get 1,400 square feet, but now they're just massive, right?
Yeah.
The other one is that 50% of the revenue needs to be driven by petroleum sales and not the store. There are some requirements. You can't have a restaurant in there. So it's like these truck stops. They're trying to prevent that the truck stops are going to qualify for the 100% bonus because they have all these different businesses and elements involved in them usually. And the third one is that 50% of the floor space needs to be dedicated to petroleum marketing. Now that's pretty hard to prove. 50% of your floor space is pretty doggone big. So
Yeah.
that one is a little bit squishy. Typically, we see that the gas stations are going to qualify for the 50% revenue coming from petroleum. 7-Elevens, they just never share the revenues. So that's one you're gonna have to fight an auditor on that if they challenge you, because if it's a 7-Eleven, you're never going to be able to get the revenues to prove that it meets the 50% rule. So now you're left with either the 1,400 square feet or the marketing. So that's up to the taxpayer to decide how much or how far they're going to push that.
Yeah, there's only so much oil cans and windshield washer fluid and that sort of thing you can put. The rest of it's junk food, right?
Yeah, exactly.
Yeah. So what else? Is there any other trends that you're seeing being in your privileged spot there with the regulators?
I think right now I'm seeing, it seems strange, but the trend right now is residential assisted living. I've probably seen this the last 3 or 4 years. Very, very interesting, some of those rules. So most states, they'll give you a license as long as you have less than 16 beds. So I have people who are buying these mega mansions, and they are renovating them and turning each of the bedrooms into an ensuite. So you have 16 rooms, and essentially, renting them out to people in lieu of them staying in a residential, facility or a living facility. So as the baby boomers are starting to progress and going into homes and needing some additional assistance, these RALs are popping up all over. I think you would be shocked to see how many residential assisted living facilities there are in your neighborhood. It's quite incredible, the growth and that we're seeing, and so I see that as a trend, and I also see some of the larger ones as a trend as well. And I have some great friends and clients who own assisted living facilities, right? This is totally different. Essentially, this is much smaller, more intimate. You have somebody on site all the time doing all your cooking and your transporting, and you only have, another few people personalities that you're dealing with, so.
Sounds like a premium option.
It's fantastic. I mean, people just are, there's such a bad rap for assisted living
Totally.
facilities than memory care. And so if you can specialize in a space and you can make it secure and safe, it's very lucrative. So we're seeing a lot of that popping up recently. Yeah.
Wow. I guess the retrofit is a combination of making sure everybody's got their own private space, elevators, so people aren't struggling to get up the stairs, that sort of thing. And
Well, it could be that you could put a chair lift in there for
yeah,
the handicap. Obviously ADA showers, those kinds of things. There's a lot to it. There are multi-level, multiple level floors in a lot of these. Because you just can't get something that big unless you're like in a space that can facilitate that. But certainly that's kind of tough to do when the land is so expensive in California or something like that. But yeah, I mean, you got to think about all the ins and outs. I mean, you got to have a transport vehicle. You're going to have, quality insurance. But that's why, those beds are expensive. They're very expensive. But people would much rather do that than be in a home.
yeah, and sometimes it's not an option to be at home by yourself.
That's exactly right.
Yeah.
I mean, and if you have somebody cooking for you and taking you to the doctor and helping you with your appointments and
That's all you really need. Yeah.
you just
Companionship, right?
yeah,
Yeah.
yeah. So I mean, it's a great concept, isn't it? I mean,
I
if
like
I had a
it.
choice, I would do that. So it's really really spreading like wildfire. So
There's a bunch of that. People built these mega mansions out here in Park City, and a lot of them are empty.
yeah,
Even though the skiing has become epic and Vail came in and all that, a lot of people are just they're sitting there.
they just got so expensive in Park City.
Yeah,
So
it's
that
out of control.
can afford that. But if there's people, we have to remember that right now we're in the largest wealth transfer in history. So we still have the baby boomers with the majority of the money. And so as they begin to transition, and they have plenty of money to spend,
Yeah.
in places like this for the most part, so in whole, this is, a lot of them are like, we don't care. We're going to be comfortable.
Yeah, and it wouldn't be too hard to staff that, right? It's like a bed and breakfast.
No, I mean, you have to have nurses usually
Yeah.
or something that can help, but it just depends on the level of care that you're planning to provide. So, but there's a lot of them out there, and they're popping up everywhere.
Well, I think that's a gem. Thanks for sharing that. Is there anything else?
That's the one. I mean, obviously car washes and gas stations, but those have been around for a while. So those of you that have hopped in on that, last couple of years did great and continue to do well. But yeah, that's the hot one for right now.
Yeah. So just tell everybody how to get a hold of you.
Yeah, thank you. My email address is Lochridge, and as you can see on the screen, so it's KLOCHRIDGE at engineered with the ED on the end, tax services with the S on the end.com. So Lochridge at engineeredtaxservices.com. You can also go to our website. We just launched a brand new website today. So that's engineeredtaxservices.com, and then you can also find my contact information there, and you can email me from the site. Would love to help you with cost segregation. We also do research and development tax credits. We do energy certifications like the 45L and the 179D. So we're very focused on specialty tax.
Is the research and development thing the same as it was in the past and rather difficult to establish, or has it gotten any better with the new tax law?
So it's difficult to establish. It's always been a challenge because you really should have a study done. You've got to establish the four-part test, and it's very difficult for companies to hire somebody to do their research and development tax credits. It's going to cost a lot more to have somebody as an employee than it is just to outsource it. And we do it every year. So essentially, you're just developing and getting all of the processes in place and substantiating the credits. But yeah, I mean, it is very difficult for a company to do it on their own. So that's where we provide that service to come in, and we will do the interviews and the appropriate gathering of documentation to establish not only the credit, but also the contemporaneous documentation that is required for claiming the credit.
Is that it's not getting any easier though, right?
No, it's not getting any easier. It's in fact, it's getting a little bit harder. So the IRS is making it, you know, pretty robust, what the requirements are to qualify for it, which is unfortunate because, you know, we want to, in our country, we want to incentivize
Innovation, right? Right,
yeah.
totally. Yeah.
I mean, that's really what we want.
Yeah.
Manufacturing, that's one of the reasons why in the OBBBA bill, Trump really focused on manufacturers, you know, because he really wants that here on the soil, and that also is research and development. So there were some things that were making it harder because they had to amortize some of those costs, and now those have gone away. So that's been helpful that they can immediately expense those assets that previously had to be amortized. But now that's gone away, but we still have the contemporaneous documentation that we have to prove. So.
Yeah. Super interesting. I always thought that was underutilized, but never really got in the weeds except for hearsay that it's difficult, right?
Yeah. Well, you know, years ago, it was reported that it was the most underutilized tax credit in the market. More so than even new market tax credits or historic tax credits. The R&D tax credit was pretty elusive. And it was in 2016 that, you know, Congress figured this out and said, kind of raised the alarm and said, why? You know, why is this so difficult? We want to incentivize innovation in this country. And that's when they allowed it, opened it up for the PATH Act in 2016 to allow those R&D tax credits, even if you're in a startup phase or if you are not profitable, that you can use those credits to offset your payroll tax. And so that's been very, very helpful in kind of really getting that out there for startup companies or anyone in VC who you know, has research and development activity.
Yeah, I think I have a customer for you.
Great.
Yes, for that. I'll share it with you after. Kim, thanks. Always great to see you. Thank you for carving out some time and doing this. I really, really appreciate it. And hope to see you here, you know, if you could head up this way.
Yeah. Well, I was actually just in Salt Lake on the weekend, and then I'll be back. My daughter is getting married there in Salt Lake next week, so
Wow.
we're spending some time. But
Yeah.
and then also New York. Just let me know.
Yeah,
I'll let you know when I'm in town too.
great. Congratulations. Thanks, Kim.
Thanks.
Bye-bye, everybody. Thanks for being with us today. Okay.
Thanks, Arthur.
Okay, I turned it off. Thank you. That was awesome.